Welcome back to the channel. I am Racky Ryan. Today I am going to be buying shares of Lockheed Martin, and I am going to show you why. The main reason why I'm going to be buying shares of Lockheed Martin is because it's undervalued, and you guessed it, it's undervalued. Beyond that, my DCF model, which calculates the intrinsic value of a stock, has this stock way higher than what it's currently trading at. That is why it's really, to me, undervalued. I'm going to break it down. I'm going to show you exactly how I came up with my price targets. Stay tuned and you will see why. As always, make sure to hit that like button as well as subscribe if you have yet to do so that you can know immediately whenever I uncover undervalued stocks.
The most important metric for running a discounted cash flow model is the free cash flow per share. This is the key ratios from Morningstar. Year 2020 free cash flow per share is not available, so we're going to go ahead and use 2019 free cash flow per share. As you can see, free cash flow per share in 2019 was $23.69. 2014 free cash flow per share was $12.98. That gives us a compound annual growth rate of 13%. Assuming a similar future growth rate, a discount rate of 10%, which is the annual return on the S&P 500, a GDP growth rate of 3%, this gives our stock an intrinsic value of $478 per share. Lockheed is currently trading at $346 per share. So you enter in the current. The model is saying that the stock is worth $478 per share, and the current price is $346. That means there is 38% upside and the stock is heavily undervalued.
So why exactly is Lockheed Martin trading lower since its high $442 per share? Well, my theory is that Wall Street thinks that defense spending is going to lessen under Biden, especially since he's going to be spending more money on stimuluses, etc.
Now let's run a scenario where we assume a lower future growth rate. So we take the same free cash flow per share from 2019 and 2014. It gives us a 13% compound annual growth rate. Let's just say that the future growth rate of the free cash flow per share is 10%. We will keep all other assumptions the same: 10% discount rate, 3% GDP. This gives us an intrinsic value of $422 per share, trading at $346. That is still 22% upside.
So assuming that defense spending is going to lessen because a lot of the government money will be going into stimuluses, let's just use a lower future growth rate.
Let's run an even more bearish scenario. I'll use a future growth rate of half of the current compound annual growth rate over the past 5 years. Let's just go ahead and say that we're going to use 6%. 10% discount rate, 3% GDP. The stock is still undervalued with 2.76% upside.
Now let's take a bullish scenario. What if there's a black swan event similar to COVID, such as war, something that's unexpected? War would do really well for Lockheed Martin. I'm not necessarily advocating for war, but statistically, history shows that America has almost been at war the entire length of its history.
Let's use a 15% future growth rate. With a 10% discount rate, 3% GDP, this gives the stock an intrinsic value of $519 per share. It's currently trading at $346. That is 50% upside. Under all four scenarios, Lockheed Martin is a buy. And I'm going to buy shares of Lockheed Martin right now.
Another piece of interesting info is that Cathie Wood at ARK has recently bought a lot of Lockheed Martin shares. I already thought that Lockheed Martin was undervalued. I have ran my model. My model says that the stock is undervalued, but this does provide some sort of confirmation bias. In summary, I ended up buying 3 shares of Lockheed Martin. I bought 2 in my regular brokerage account, and I bought 1 in my IRA account. I plan on never selling Lockheed Martin. If you are watching and you are worried that there might be some sort of market crash or market correction, That certainly could happen, but the most important thing to remember with investing is time in the market is more important than timing the market. If you are always trying to buy at the low and sell at the high, you're going to have an incredibly challenging time to do that. Also, you're going to be missing out on dividends, which tend to compound over time. And always remember what Albert Einstein said: compound interest is the eighth wonder of the world. He who understands it earns it, and he who does not pays it. So the next stock that I'm going to be valuing is Zynga stock. A subscriber commented on my Cisco valuation asking if I could value Zynga. I own shares of Zynga already, and I'm going to value the stock to see what I think the stock is now worth today. If you are interested in me valuing a stock for you, comment below saying which stock you would want me to take a look at, and chances are I might go ahead and do it. Once again, make sure to hit the like button as well as subscribe if you're not already subscribed so you can see my latest video on Zynga.